Part 5. The New Deal and the International Monetary System. The international monetary policies of the New Deal may be divided into two decisive and determining actions, one at the beginning of the New Deal and the other at its end. The first was the decision, in early 1933, to opt for domestic inflation and monetary nationalism, a course that helped steer the entire world onto a similar path during the remainder of the decade. The second was the thrust, during World War II, to reconstitute an international monetary order, this time built on the dollar as the world's, quote, key and crucial currency. If we wish to use lurid terminology, we might call these a decision for dollar nationalism and dollar imperialism, respectively. The background of the 1920s. It is impossible to understand the first New Deal decision for dollar nationalism without setting that choice in the monetary world of the 1920s, from which the New Deal emerged. Similarly, it is impossible to understand the monetary system of the 1920s without reference to the pre-World War I monetary order and its breakup during the war. For the world of the 1920s was an attempt to reconstitute an international monetary order, seemingly one quite similar to the status quo ante, but actually based on very different principles and institutions. The pre-war monetary order was genuinely, quote, international. That is, world money rested not on paper tickets issued by one or more governments, but on a genuine economic commodity, gold, whose supply rested on market supply and demand principles. In short, the international gold standard was the monetary equivalent and corollary of international free trade in commodities. It was a method of separating money from the state, just as enterprise and foreign trade had been so separated. In short, the gold standard was the monetary counterpart of laissez-faire in other economic areas. The gold standard in the pre-war era was never, quote, pure, no more than was laissez-faire in general. Every major country, except the United States, had central banks which tried their best to inflate and manipulate the currency. But the system was such that this intervention could only operate within narrow limits. If one country inflated its currency, the inflation in that country would cause the banks to lose gold to other nations, and consequently the banks, private and central, would before long be brought to heel. And while England was the world financial center during this period, its predominance was market rather than political, so it too had to abide by the monetary discipline of the gold standard. As H. Parker Willis described it, quote, prior to the World War, the distribution of the metallic money of gold standard countries had been directed and regulated by the central banks of the world, in accordance with the generally known and recognized principles of international distribution of the precious metals. Free movement of these metals and freedom on the part of the individual to acquire and hold them were general. Regulation of foreign exchange existed only sporadically, and was so conducted as not to interfere in any important degree with the disposal of holding of specie by individuals or by banks. End quote. The advent of the World War disrupted and rended this economic idol, and it was never to return. In the first place, all of the major countries financed the massive war effort through an equally massive inflation, which meant that every country except the United States, even including Great Britain, was forced to go off the gold standard, since they could no longer hope to redeem their currency obligations in gold. The international order not only was sundered by the war, but also split into numerous separate, competing, and warring currencies, whose inflation was no longer subject to the gold restraint. In addition, the various governments engaged in rigorous exchange control, fixing exchange rates and prohibiting outflows of gold. Monetary warfare paralleled the broader economic and military conflict. At the end of the war, the major powers sought to reconstitute some form of international monetary order out of the chaos and warring economic blocs of the war period. The crucial actor in this drama was Great Britain, which was faced with a series of dilemmas and difficulties. On the one hand, Britain not only aimed at re-establishing its former eminence, but it meant to use its victorious position and its domination of the League of Nations to work its will upon the other nations, many of them new and small, of post-Versailles Europe. This meant its monetary as well as its general political and economic dominance. Furthermore, it no longer felt itself bound by old-fashioned, laissez-faire restraints from exerting frankly political control, nor did it any longer feel bound to observe the classical gold standard restraints against inflation. While Britain's appetite was large, its major dilemma was its weakness of resources. The racking inflation and the withdrawal from the gold standard had left the United States, not Great Britain, as the only, quote, hard gold standard country. If Great Britain were to dominate the post-war monetary picture, it would somehow have to take the United States into camp as its willing junior partner. From the classic pre-war pound-dollar par of $4.86 to the pound had fallen on the international money markets to $3.50, a substantial 30% drop. A drop that reflected the greater degree of inflation in Great Britain than in the U.S. The British then decided to constitute a new form of international monetary system, the, quote, gold exchange standard, which it finally completed in 1925. In the classical pre-war gold standard, each country kept its reserves in gold and redeemed its paper and bank currencies in gold coin upon demand. The new gold exchange standard was a clever device to permit Britain and the other European countries to remain inflated and to continue inflating, while enlisting the United States as the ultimate support for all currencies. Specifically, Great Britain would keep its reserves, not in gold, but in dollars, while the smaller countries of Europe would keep their reserves, not in gold, but in pounds sterling. In this way, Great Britain could pyramid inflated currency and credit on top of dollars, while Britain's client states could pyramid their currencies, in turn, on top of pounds. Clearly, this also meant that only the United States would remain on a gold coin standard, the other countries, quote, redeeming only in foreign exchange. The instability of this system, with pseudo-gold standard countries pyramiding on top of an increasingly shaky dollar-gold base, was to become evident in the Great Depression. But the British task was not simply to induce the United States to be the willing guarantor of all the shaky and inflated currencies of war-torn Europe. For Great Britain might well have been able to return to the original form of gold standard at a new, realistic, depreciated parity of $3.50 to the pound. But it was not willing to do so. For the British dream was to restore, even more glowingly than before, British financial preeminence, and if it depreciated the pound by 30%, it would thereby acknowledge that the dollar, not the pound, was the world financial center. This it was fiercely unwilling to do. For restoration of dominance, for the saving of financial face, it would return at the good old $4.86, or bust in the attempt. And bust it almost did. For to insist on returning to gold at $4.86, even on the new, vitiated gold exchange basis, was to mean that the pound would be absurdly expensive in relation to the dollar and other currencies, and would therefore mean that at current inflated price levels, Britain's exports, its economic lifeline, would be severely crippled, and a general depression would ensue. And indeed, Britain suffered a severe depression in her export industries, particularly coal and textiles, throughout the 1920s. If she insisted on returning at the overvalued $4.86, there was only one hope for keeping her exports competitive in price: a massive domestic deflation to lower price and wage levels. While a severe deflation is difficult at best, Britain now found it impossible, for the new system of national unemployment insurance and the newfound strength of trade unions made wage cutting politically unthinkable. But if Britain would not or could not make her exports competitive by returning to gold at a depreciated par, or by deflating at home, there was a third alternative which it could pursue, and which indeed marked the key to the British international economic policies of the 1920s. It could induce or force other countries to inflate, or themselves to return to gold at overvalued pars. In short, if it could not clean up its own economic mess, it could contrive to impose messes upon everyone else. If it did not do so, it would see inflating Britain lose gold to the United States, France, and other, quote, hard money countries, as indeed happened during the 1920s. Only by contriving for other countries, especially the U.S., to inflate also, could it check the loss of gold and therefore halt the collapse of the whole jerry-built international monetary structure. In the short run, the British scheme was brilliantly conceived, and it worked for a time. But the major problem went unheeded. If the United States, the base of the pyramid and the sole link of all these countries to gold and hard money, were to inflate unduly, the dollar too would become shaky. It would lose gold at home and abroad, and the dollar would itself eventually collapse, dragging the entire structure down with it. And this is essentially what happened in the Great Depression. In Europe, England was able to use its domination of the powerful Financial Committee of the League of Nations to cajole or bludgeon country after country to 1. Establish central banks that would collaborate closely with the Bank of England, 2. Return to gold, not in the classical gold coin standard, but in the new gold exchange standard, which would permit continued inflation by all the countries, and 3. Return to this new standard at overvalued pars so that European exports would be hobbled vis-à-vis the exports of Great Britain. The Financial Committee of the League of Nations was largely dominated and run by Britain's major financial figure, Montague Norman, head of the Bank of England, working through such close Norman associates on the committee as Sir Otto Niemeyer and Sir Henry Strakosch, leaders in the concept of close central bank collaboration to, quote, stabilize, in practice to raise, price levels throughout the world. The distinguished British economist Sir Ralph Hawtrey, Director of Financial Studies at the British Treasury, was one of the first to advocate this system, as well as to call for the general European adoption of a gold exchange standard. In the spring of 1922, Norman induced the League to call the Genoa Conference, which urged similar measures. But the British scarcely confined their pressure upon European countries to resolutions and conferences. Using the carrot of loans from England and the United States, and the stick of political pressure, Britain induced country after country to order its monetary affairs to suit the British. That is, to return only to a gold exchange standard at overvalued pars that would hamper their own exports and stimulate imports from Great Britain. Furthermore, the British also used their inflated, cheap credit to lend widely to Europe in order to stimulate their own flagging export market. A trenchant critique of British policy was recorded in the diary of Émile Moreau, governor of the Bank of France, a country that clung to the gold standard and to a hard money policy, and was thereby instrumental in bringing down the pound and British financial domination in 1931. Moreau wrote, quote, England, having been the first European country to re-establish a stable and secure money, has used that advantage to establish a basis for putting Europe under a veritable financial domination. The Financial Committee of the League of Nations at Geneva has been the instrument of that policy. The method consists of forcing every country in monetary difficulty to subject itself to the committee at Geneva, which the British control. The remedies prescribed always involve the installation in the central bank of a foreign supervisor who is British or designated by the Bank of England, and the deposit of a part of the reserve of the central bank at the Bank of England, which serves both to support the pound and to fortify British influence. To guarantee against possible failure, they are careful to secure the corporation of the Federal Reserve Bank of New York. Moreover, they pass on to America the task of making some of the foreign loans if they seem too heavy, always retaining the political advantage of these operations. England is thus completely or partially entrenched in Austria, Hungary, Belgium, Norway, and Italy. She is in the process of entrenching herself in Greece and Portugal. She seeks to get a foothold in Yugoslavia and fights as cunningly in Romania. The currencies will be divided into two classes. Those of the first class, the dollar and the pound sterling, based on gold, and those of the second class based on the pound and the dollar, with a part of their gold reserves being held by the Bank of England and the Federal Reserve Bank of New York. The latter monies will have lost their independence. End quote. Inducing the United States to support and bolster the pound and the gold exchange system was vital to Britain's success, and this cooperation was ensured by the close ties that developed between Montague Norman and Benjamin Strong, governor of the Federal Reserve Bank of New York, who had seized effective and nearly absolute control of Federal Reserve operations from his appointments at the inception of the Fed in 1914 until his death in 1928. This control over the Fed was achieved over the opposition of the Federal Reserve Board in Washington, which generally opposed or grumbled at Strong's Anglophile policies. Strong and Norman made annual trips to visit each other, all of which were kept secret not only from the public but from the Federal Reserve Board itself. Strong and the Federal Reserve Bank of New York propped up England and the gold exchange standard in numerous ways. One was direct lines of credit, which the New York Bank extended in 1925 and after to Britain, Belgium, Poland, and Italy to subsidize their going to a gold exchange standard at overvalued pars. More directly significant was a massive monetary inflation and credit expansion which Strong generated in the United States in 1924 and again in 1927, for the purpose of propping up the pound. The idea was that gold flows from Britain to the United States would be checked and reversed by American credit expansion, which would prop up or raise prices of American goods, thereby stimulating imports from Great Britain and also lower interest rates in the U.S. as compared to Britain. The fall in interest rates would further stimulate flows of gold from the U.S. to Britain, and thereby check the results of British inflation and overvaluation of the pound. Both times, the inflationary injection worked and prevented Britain from reaping the results of its own inflationary policies, but at the high price of inflation in the United States, a dangerous stock market and real estate boom, and an eventual depression. At the secret central bank conference of July 1927 in New York, called at the behest of Norman, Strong agreed to this inflationary credit expansion over the objections of Germany and France, and Strong gaily told the French representative that he was going to give, quote, a little coup de whiskey to the stock market. It was a coup for which America and the world would pay dearly. The Chicago business and financial community, not having Strong's ties with England, protested vigorously against the 1927 expansion, and the Federal Reserve Bank of Chicago held out as long as it could against the expansion of cheap money and the lowering of interest rates. The Chicago Tribune went so far as to call for Strong's resignation and perceptively charged that discount rates were being lowered in the interest of Great Britain. Strong, however, sold the policy to the Middle West with the rationale that its purpose was to help the American farmer by means of cheap credit. In contrast, the English financial community hailed the work of Norman in securing Strong's support, and the Banker of London lauded Strong as, quote, one of the best friends England ever had. The banker praised the, quote, energy and skillfulness he, Strong, has given to the service of England, and exalted that, quote, his name should be associated with that of Mr. Walter Hines Page as a friend of England in her greatest need, end quote. A blatant example of Strong's intervention to help Norman and his policy occurred in the spring of 1926, when one of Norman's influential colleagues proposed a full gold coin standard in India. At Norman's request, Strong and a team of American economists rushed to England to ward off the plan, testifying that a gold drain to India would check inflation in other countries, and instead they successfully backed the Norman policy of a gold exchange standard and domestic, quote, economizing of gold, to permit domestic expansion of credit. The intimate Norman-Strong collaboration for joint inflation and the gold exchange standard was not at all an accident of personality. It was firmly grounded on the close ties that both of them had with the House of Morgan and the Morgan interests. Strong himself was a product of the Morgan nexus. He had been the head of the Morgan-oriented Bankers Trust Company before becoming governor of the New York Fed, and his closest ties were with Morgan partners Henry P. Davidson and Dwight Morrow, who induced him to assume his post at the Federal Reserve. J.P. Morgan and Company, in turn, was an agent of the British governments and of the Bank of England, and its close financial ties with England, its loans to England, and tie-ins with the American export trade had been highly influential in inducing the United States to enter World War I on England's side. As for Montague Norman, his grandfather had been a partner in the London banking firm of Brown, Shipley and Company, and of the affiliated New York firm of Brown Brothers and Company, a powerful investment banking firm long associated with the House of Morgan. Norman himself had been a partner of Brown, Shipley, and had worked for several years in the offices of Brown Brothers in the United States. Moreover, J.P. Morgan and Company played a direct, collaborative role with the New York Fed, lending $100 million of its own to Great Britain in 1925 to facilitate its return to gold, and also collaborating in feudal loans to prop up the shaky European banking system during the financial crisis of 1931. It is no wonder that in his study of the Federal Reserve System during the pre-New Deal era, Dr. Clark concluded that, quote, the New York Reserve Bank, in collaboration with a private international banking house, J.P. Morgan and Company, determined the policy to be followed by the Federal Reserve System. End quote. The major theoretical rationale employed by Strong and Norman was the idea of governmental collaboration to, quote, stabilize the price level. The laissez-faire policy of the classical pre-war gold standard meant that prices would be allowed to find their own level in accordance with supply and demand, and without interference by central bank manipulation. In practice, this meant a secularly falling price level, as the supply of goods rose over time in accordance with the long-run rise in productivity. And in practice, price stabilization really meant price raising, either keeping prices up when they were falling, or, quote, reflating prices by raising them through inflationary action by the central banks. Price stabilization, therefore, meant the replacement of the classical laissez-faire gold standard by, quote, managed money, by inflationary credit expansion stimulated by the central banks. In England, it was, as we have seen, no accident that the lead in advocating price stabilization was taken by Sir Ralph Hawtrey and various associates of Montague Norman, including Sir Josiah Stamp, chairman of Midland Railways and a director of the Bank of England, and two other prominent directors, Sir Basil Blackett and Sir Charles Addis. It long has been a myth of American historiography that bankers and big businessmen are invariably believers in, quote, hard money as against cheap credits or inflation. This was certainly not the experience of the New Deal or the pre-New Deal era. While the most articulate leaders of the price stabilizationists were academic economists led by Professor Irving Fisher of Yale, Fisher was able to enlist in his Stable Money League, founded 1921, and its successor, the Stable Money Association, a host of men of wealth, bankers, and businessmen, as well as labor and farm leaders. Among those serving as officers of the League and Association were Henry Agard Wallace, editor of Wallace's Farmer and Secretary of Agriculture in the New Deal, the wealthy John G. Winant, later governor of New Hampshire, George Eastman of the Eastman Kodak family, Frederick H. Goff, head of the Cleveland Trust Company, John E. Ravensky, executive vice president of the Bank of America, Frederick Delano, uncle of Franklin D. Roosevelt, Samuel Gompers, John P. Frey, and William Green of the American Federation of Labor, Paul M. Warburg, partner of Kuhn Leb and Company, Otto H. Kahn, prominent investment banker, James H. Rand, Jr., head of Remington Rand Company, and Owen D. Young of General Electric. Furthermore, the heads of the following organizations agreed to serve as ex officio honorary vice presidents: the American Association for Labor Legislation, the American Bar Association, the American Farm Bureau Federation, the Brotherhood of Railroad Trainmen, the National Association of Credit Men, the National Association of Owners of Railroad and Public Utility Securities, the National Retail Dry Goods Association, the United States Building and Loan League, the American Cotton Growers Exchange, the Chicago Association of Commerce, the Merchants Association of New York, and the heads of the Bankers Associations of 43 states and the District of Columbia. Irving Fisher was unsurprisingly exultant over the supposed achievements of Governor Strong in stabilizing the wholesale price level during the late 1920s, and he led American economists in trumpeting the, quote, new era of permanent prosperity which the new policy of managed money was assuring to America and the world. Fisher was particularly critical of the minority of skeptical economists who warned of overexpansion in the stock and real estate markets due to cheap money, and even after the stock market crash, Fisher continued to insist that prosperity, particularly in the stock market, was just around the corner. Fisher's partiality towards stock market inflation was perhaps not unrelated to his own personal role as a millionaire investor in the stock market, a role in which he was financially dependent on a cheap money policy. In the general enthusiasm for Strong and the new era of monetary and stock market inflation, the minority of skeptics was led by the Chase National Bank, affiliated with the Rockefeller interests, particularly A. Barton Hepburn, economic historian and chairman of the board of the bank, and Chase National's chief economist, Dr. Benjamin M. Anderson, Jr. Another highly influential and indefatigable critic was Dr. H. Parker Willis, editor of the Journal of Commerce, formerly aide to Senator Carter Glass, Democrat from Virginia, and professor of banking at Columbia University, along with Willis's numerous students, who included Dr. Ralph W. Roby, later to become economist at the National Association of Manufacturers. Another critic was Dr. Rufus S. Tucker, economist at General Motors. On the Federal Reserve Board, the major critic was Dr. Adolph C. Miller, a close friend of Herbert Hoover, who joined in the criticisms of the strong policy. On the other hand, Treasury Secretary Andrew W. Mellon, of the powerful Mellon interests, enthusiastically backed the inflationist policy. This split in the nation's leading banking and business circles was to foreshadow the split over Franklin Roosevelt's monetary departures in 1933. The first New Deal. Dollar nationalism. The international monetary framework of the 1920s collapsed in the storm of the Great Depression. Or rather, it collapsed of its own inner contradictions in a depression which it had helped to bring about. For one of the most calamitous features of the Depression was the international wave of banking failures, and the banks failed from the inflation and overexpansion which were the fruits of the managed international gold exchange standard. Once the jerry-built pyramiding of bank credit had collapsed, it brought down the banking system of nation after nation, as inflation led to a piling up of currency claims abroad. The cashing in of the claims led to a well-founded suspicion of the solvency of other banks, and so the failures spread and intensified. The failures in the weak currency countries led to the accumulation of strains in other weak currency nations, and ultimately on the bases of the shaky pyramid, Britain and the United States. The major banking crisis began with the near bankruptcy in 1929 of the Baden Credit Anstalt of Vienna, the major bank in Austria, which had never recovered from its dismemberment at Versailles. Desperate attempts by J.P. Morgan, the House of Rothschild, and later the New York Fed to shore up the bank only succeeded in a temporary rescue which committed more financial resources to an unsound bank and thereby made its ultimate failure in May 1931 all the more catastrophic. Rather than permit the outright liquidation of their banking systems, Austria, followed by Germany and other European countries, went off the gold standard during 1931. But the key to the international monetary situation was Great Britain, the nub and the base for the world's gold exchange standard. British inflation and cheap money, and the standard that had made Britain the base of the world's money, put enormous pressure on the pound sterling, as foreign holders of sterling balances became increasingly panicky and called on the British to redeem their sterling in either gold or dollars. The heavy loans by British banks to Germany during the 1920s made the pressure after the German monetary collapse still more severe. But Britain could have saved the day by using the classical gold standard medicine in such crises, by raising bank interest rates sharply, thereby attracting funds to Britain from other countries. In such monetary crises, furthermore, such temporary tight money and checks to inflation give foreigners confidence that the pound will be sustained, and they then continue to hold sterling without calling on the country for redemption. In earlier crises, for example, Britain had raised its bank rate as high as 10% early in the proceedings, and temporarily contracted the money supply to put a stringent check to inflation. But by 1931, deflation and hard money had become unthinkable in the British political climate. And so Britain stunned the financial world by keeping its bank rate very low, never raising it above 4.5%, and in fact continuing to inflate sterling still further to offset gold losses abroad. As the run on sterling inevitably intensified, Great Britain cynically repudiated its own gold exchange standard, the very monetary standard that it had forced and cajoled Europe to adopt, by coolly going off the gold standard in September 1931. Its own international monetary system was sacrificed on the altar of continued domestic inflation. The European monetary system was thereby broken up into separate and even warring currency blocks, replete with fluctuating exchange rates, exchange control, and trade restrictions. The major countries followed Britain off the gold standard, with the exception of Belgium, Holland, France, Italy, Switzerland, and the United States. Currency blocks formed with the British Empire, forming a sterling bloc, with parities mutually fixed in relation to the pound. It is particularly ironic that one of the earliest effects of Britain's going off gold was that the overvalued pound, now free to fluctuate, fell to its genuine economic value, at or below $3.40 to the pound. And so, Britain's grand experiment in returning to a form of gold at an overvalued par had ended in disaster, for herself as well as for the rest of the world. In the last weeks of the Hoover administration, a desperate attempt was made by the U.S. to restore an international monetary system. This time, the offer was made to Britain to return to the gold standard at the current, eminently more sensible par, in exchange for substantial reduction of the British war debt. No longer would Britain be forced by overvaluation to be in a chronic state of depression of its export industries. But Britain now had the nationalist bit in its teeth, and it insisted on outright, quote, reflation of prices back up to the pre-Depression 1929 levels. It had become increasingly clear that the powerful, quote, price stabilizationists were interested not so much in stabilization as in high prices, and now they would only be satisfied with an inflationary return to boom prices. Britain's rejection of the American offer proved to be fatal for any hopes of international monetary stability. The world's monetary fate finally rested with the United States, the major gold standard country still remaining. Federal Reserve attempts to inflate the money supply and to lower interest rates during the Depression further weakened confidence in the dollar, and gold outflows combined with runs and failures of the banks to put increasing pressure on the American banking system. Finally, during the interregnum between the Hoover and Roosevelt administrations, the nation's banks began to collapse in earnest. The general bank collapse meant that the banking system, always unsound and incapable of paying more than a fraction of its liabilities on demand, could only go in either of two opposite directions. A truly laissez-faire policy would have allowed the failing banks to collapse, and thereby to engage in a swift, sharp, surgical operation that would have transformed the nation's monetary system from an unsound, inflationary one to a truly, quote, hard and stable currency. The other pull was for the government to declare massive, quote, bank holidays, that is, to relieve the banks of the obligation to pay their debts, and then move on to the repudiation of the gold standard and its replacement by inflated fiat paper issued by the government. It is important to realize that neither the Hoover nor the Roosevelt administrations had any intention of taking the first route. While there was a considerable split on whether or not to stay on the gold standard, no one endorsed the rigorous laissez-faire route. The new Roosevelt administration was now faced with the choice of retaining or going off the gold standard. While most everyone supported the temporary, quote, bank holidays, there was a severe split on the longer-run question of the monetary standard. While the bulk of the nation's academic economists stood staunchly behind the gold standard, the indefatigable Irving Fisher redoubled his agitation for inflation, spurred onward by his personal desire to reinflate stock prices. Since the Stable Money Association had been supposedly dedicated to price stabilization, and what Fisher and the inflationists wanted was a drastic raising of prices, the association liquidated its assets into the new and frankly inflationist Committee for the Nation to Rebuild Prices and Purchasing Power. The Committee for the Nation, founded in January 1933, stood squarely for the, quote, reflation of prices back to their pre-1929 levels. Stabilization of the price level was to proceed only after that point had been achieved. The Committee for the Nation, which was to prove crucially influential on Roosevelt's decision, was composed largely of prominent businessmen. The committee was originated by Vincent Bendix, president of Bendix Aviation, and General Robert E. Wood, head of Sears, Roebuck and Company. They were soon joined, in the fall of 1932, by Frank A. Vanderlip, long close to Fisher and former president of the National City Bank of New York, by James H. Rand, Jr. of Remington Rand, and by Magnus W. Alexander, head of the National Industrial Conference Board. Other members of the Committee for the Nation included Fred H. Sauer, president of the Dairymen's League Cooperative Association, Frederick H. Fraser, chairman of the board of the General Baking Company, automobile magnate E. L. Cord, Lessig J. Rosenwald, chairman Sears Roebuck, Samuel S. Fells of Fells and Company, Philip K. Wrigley, president of William Wrigley Company, John Henry Hammond, chairman of the board of Bangor and Aroostook Railroad, Edward A. O'Neill, head of the American Farm Bureau Federation, L. J. Tauber, head of the National Grange, F. R. Wurlitzer, vice president of Rudolph Wurlitzer Manufacturing Company, William J. McAveny, president of Hudson Motor Company, Frank E. Gannett of Gannett Newspapers, and Indiana banker William A. Wirt. Interestingly enough, this same group of highly conservative industrialists was later to become the Committee for Constitutional Government, the major anti-New Deal propaganda group of the late 1930s and 1940s. Yet the committee was the major proponent of the inflationist policy of the early New Deal in reflating and abandoning the gold standard. Also associated with the Committee for the Nation was another great influence on Franklin Roosevelt's decision, agricultural economist George F. Warren of Cornell, who, along with his colleague Frank A. Pearson, was the inspiration for the reflationist Roosevelt program of continually raising the buying price of gold. The Committee for the Nation at first included several hundred industrial and agricultural leaders, and within a year its membership reached over 2,000. Its recommendations, beginning with going off gold and embargoing gold exports, and continuing through devaluing the dollar and raising the price of gold, were fairly closely followed by the Roosevelt administration. For his part, Irving Fisher, in response to a request for advice by President-elect Roosevelt, had strongly urged at the end of February a frankly inflationist policy of reflation, devaluation, and leaving the gold standard without delay. By April 19th, when Roosevelt had cast the die for this policy, Fisher exulted, quote, "Now I am sure, as far as we can ever be sure of anything, that we are going to snap out of this depression fast. I am now one of the happiest men in the world." End quote. In the same letter to his wife, an heiress of the substantial Hazard family fortune, Fisher added, quote, "My next big job is to raise money for ourselves. Probably we'll have to go to Sister, his wife's sister Carolyn, again. I have defaulted payments the last few weeks because I did not think it was fair to ask Sister for money when there was a real chance that I could never pay it back. I mean that if FDR had followed Glass, we would have been pretty surely ruined. So would Allied Chemical, in which much of his wife's family fortune was invested, and the U.S. government. Now I can go to Sister with a clean conscience." End quote. If Irving Fisher's interest was personal as well as ideological, economic interests also underlay the concern of the Committee for the Nation. The farm groups wanted farm prices driven up, including farm export prices, which necessarily increase in terms of other currencies whenever a currency is devalued. As for the rest of the committee and other inflationists, Herbert Feiss notes, quote, "By the spring of 1933, diverse organizations and groups were crying aloud for some kind of monetary inflation or devaluation, or both. Most effective, probably, was the Committee for the Nation. Among its members were prominent merchants, such as the head of Sears Roebuck, some journalists, some Wall Street operators, and some foreign exchange speculators. Their purpose was to get the United States off the gold standard and to bring about devaluation of the dollar, from which they would profit either as speculators in foreign exchange or as businessmen. Another group, more conservative, who stood to gain by devaluation were those who had already exported gold or otherwise acquired liquid deposits in foreign banks. They conceived that they were merely protecting the value of their capital. Then there were the exporters, especially of farm products, who had been at a disadvantage ever since Great Britain had gone off the gold standard and the value of sterling had fallen much below its previous parity with the dollar. End quote. Also advocating and endorsing the decision to inflate and leave the gold standard were such conservative bankers as James P. Warburg of Kuhn Leb and Company, one of Roosevelt's leading monetary advisors, Chicago banker and former Vice President Charles G. Dawes, Melvin A. Traylor, president of the First National Bank of Chicago, Frank Altschul of the International Banking House of Lazard Frere, and Russell C. Leffingwell, partner of J.P. Morgan and Company. Leffingwell told Roosevelt that his action, quote, was vitally necessary and the most important of all helpful things you have done, end quote. Morgan himself hailed Roosevelt's decision to leave the gold standard. Quote, I welcome the reported action of the President and the Secretary of the Treasury in placing an embargo on gold exports. It has become evident that the effort to maintain the exchange value of the dollar at a premium as against depreciated foreign currencies was having a deflationary effect upon already severely deflated prices and wages and employment. It seems to me clear that the way out of the depression is to combat and overcome the deflationary forces. Therefore, I regard the action now taken as being the best possible course under the circumstances. End quote. Other prominent advocates of going off gold were publishers J. David Stern and William Randolph Hearst, financier James H. R. Cromwell, and Dean Wallace Donham of the Harvard Business School. Conservative Republican senators such as David A. Reed of Pennsylvania and Minority Leader Charles L. McNary of Oregon also approved the decision, and Senator Arthur Vandenberg, Republican of Michigan, happily declared that Americans could now compete in the export trade, quote, for the first time in many, many months, end quote. Vandenberg concluded that, quote, abandonment of the dollar externally may prove to be a complete answer to our problem, so far as the currency factor is concerned, end quote. Amidst this chorus of approval from leading financiers and industrialists, there was still determined opposition to going off gold. Aside from the bulk of the nation's economists, the lead in opposition was taken again by two economists with close ties to the banking community, who had been major opponents of the strong Morgan policies during the 1920s. Dr. Benjamin M. Anderson of the Rockefeller-oriented Chase National Bank, and Dr. H. Parker Willis, editor of the Journal of Commerce and chief advisor to Senator Carter Glass, Democrat of Virginia, who had been Secretary of the Treasury under Wilson. The Chamber of Commerce of the United States also vigorously attacked the abandonment of gold as well as price-level stabilization, and the Chamber of Commerce of New York State called for prompt return to gold. From the financial community, leading opponents of Roosevelt's decision were Winthrop W. Aldrich, a Rockefeller kinsman and head of Chase National Bank, and Roosevelt's budget director, Lewis W. Douglas, of the Arizona mining family, who was related to the J. Henry Schroeder International Bankers and was eventually to become head of Mutual Life Insurance Company and ambassador to England. Douglas fought valiantly, but in vain, within the administration against going off gold and against the remainder of the New Deal program. By the end of April 1933, the United States was clearly off the gold standard, and the dollar quickly began to depreciate relative to gold and the gold standard currencies. Britain, which a few weeks earlier had loftily rejected the idea of international stabilization, now became frightened. Currency blocks and a depreciating pound to aid British exports were one thing. Depreciation of the dollar to spur American exports and injure British exports was quite another. The British had the presumption to scold the United States for going off gold, They now rested their final hope for a restored international monetary system on the World Economic Conference scheduled for London in June 1933. Preparations for the conference had been underway for a year under the guidance of the League of Nations in a desperate attempt to aid the world economic and financial crisis by attempting the, quote, restoring of the currencies on a healthy basis, end quote. The Hoover administration was planning to urge the restoration of the international gold standard, but the abandonment of gold by the Roosevelt administration in March and April 1933 changed the American position radically. As the conference loomed ahead, it was clear that there were three fundamental positions. The gold bloc, the countries still on the gold standard, headed by France, which desired immediate return to a full international gold standard with fixed exchange rates between the major currencies and gold. The United States, which now placed greatest stress on domestic inflation of the price level, and the British, supported by their dominions, who wished some form of combination of the two. What was still unclear was whether a satisfactory compromise between these divergent views could be worked out. At the invitation of President Roosevelt, Prime Minister Ramsay MacDonald of Great Britain and leading statesmen of the other major countries journeyed to Washington for individual talks with the president. All that emerged from these conversations were vague agreements of intent. But the most interesting aspect of the talks was an American proposal, originated by William C. Bullitt and rejected by the French, to establish a coordinated worldwide inflation and devaluation of currencies. Quote, there was serious discussions of a proposal, sponsored by the United States and vigorously opposed by the gold countries, that the whole world should embark upon a, quote, cheaper money policy, not only through a vigorous and concerted program of credit expansion and the stimulation of business enterprise by means of public works, but also through a simultaneous devaluation by a fixed percentage of all currencies which were still at their pre-depression parities. End quote. The American delegation to London was a mixed bag, but the conservative gold standard forces could take heart from the fact that staff economic advisor was James P. Warburg, who had been working eagerly on a plan for international currency stabilization based on gold at new and realistic parities. Furthermore, conservative Professor Oliver M. W. Sprague and George L. Harrison, governor of the New York Fed, were sent to discuss proposals for temporary stabilization of the major currencies. In contrast, the president paid no attention to the petition of 85 congressmen, including 10 senators, that he appoint as his economic advisor to the conference the radical inflationist and anti-gold priest, Father Charles E. Coughlin. The World Economic Conference, attended by delegates from 64 major nations, opened in London on June 12th. The first crisis occurred over the French suggestion for a temporary, quote, currency truce, a de facto stabilization of exchange rates between the franc, dollar, and pound for the duration of the conference. Surely eminently reasonable, the plan was also a clever device for an entering wedge toward a hopefully permanent stabilization of exchange rates on a full gold basis. The British were amenable, provided that the pound remained fairly cheap in relation to the dollar, so that their export advantage gained since 1931 would not be lost. On June 16th, Sprague and Harrison concluded an agreement with the British and French for temporary stabilization of the three currencies, setting the dollar sterling rate at about $4 per pound, and pledging the United States not to engage in massive inflation of the currency for the duration of the agreement. The American representatives urged Roosevelt to accept the agreement, with Sprague warning that, quote, a failure now would be most disastrous, end quote, and Warburg declaring that without stabilization, quote, it would be practically impossible to assume a leading role in attempting to bring about a lasting economic peace, end quote. But Roosevelt quickly rejected the agreement on June 17th, giving two reasons: that the pound must be stabilized at no cheaper than $4.25, and that he could not accept any restraint on his freedom of action to inflate in order to raise domestic prices. Roosevelt ominously concluded that, quote, "It is my personal view that far too much importance is being placed on existing and temporary fluctuations," end quote. And lest the American delegation take his reasoning as a stimulus to renegotiate the agreement, Roosevelt reminded Hull on June 20th, quote, "Remember that far too much influence is attached to exchange stability by banker-influenced cabinets," end quote. Upon receiving the presidential veto, the British and French were indignant, and George Harrison quit and returned home in disgust.